Friday, November 11th, 10th, last time I looked. The temptation to delve into political affairs that have financial connections is always overwhelming for me, but today I'm going to hold off until the end. The real economics at hand, there's something really unusual going on. We have the world's economies in a process of synchronization, or synchrony. That doesn't happen very often, that all of the big regions in the world take off at the same time. And in the past, when they have, it has never ended well. That's not what's happening this time. Usually when they synchronize, we all overheat. We go into inflation or blown bubbles, and it ends badly, and then we break up and fail to synchronize for a long time. This time, the synchronization is clearly driven by the world's central banks. We have four big regions. We have the United States, Europe, Japan, and China. And all four central banks are in, to one degree or another, hysterical stimulus, monetary stimulus. Only in the United States has the Fed begun to back off of that stimulus, very tentatively. The Fed is raising short-term interest rates, but credit conditions are anything but tight. But if you look at the affairs in Europe and Japan and China, they're all out of their minds, still at it with the gas pedal on the floor. China has some big talk about limiting its debt creation. It's been China's pattern that whenever it does anything that would slow its economy, it finds a way to export the consequences somewhere else. Europe looks fairly good, but it's really just the same as it's been, masked by the central bank. The direct consequence to U.S. housing is these central banks are so easy, they are such fountains of cash, that their own domestic interest rates are suppressed. A German 10-year bond pays barely 0.4%. Ours pays 2% more than that. We pay 2.40. A U.S. 2-year Treasury note, which tends to follow the Fed, today traded at 1.65% yield. A German 2-year note trades at negative 0.75%. Our yields seem low to us, and they are, but they are very, very high compared to the rest of the world. So the Fed is pushing up on short-term interest rates, but long-term ones aren't moving. At some point that may force the Fed to become more aggressive than it is, but whatever. In the meantime, even though the Fed is coming up, it's going to tighten again next month, the force of overseas central banks is holding down U.S. long-term rates and mortgage rates. And for that, holy smokes, thanks. Thanksgiving. But a brief moment of black humor. In this extraordinary political year, we watch markets all day, every day, looking for political event and consequence, and they're very rare. We're in the process of putting together easily the worst piece of tax legislation in my lifetime. No particular effect until Wednesday. On Wednesday, it came clear that the great big corporate tax cut is likely to be delayed from next year to 2019. Stock market tanked. I mean, it tanked hard. It was down 250 points, no bottom, until some more news came out that wasn't quite as grim about that tax cut. Now, the proponents of the tax bill say that if corporate taxes are cut, corporations will then dramatically increase the wages that they pay. The stock market clearly believes otherwise. The stock market is trading up on the thought of a tax cut, which the stock market would get to keep. And there's no brief that wages will go up. Maybe the strangest thing in this report is for a substantial tax cut, a substantial tax reorganization, there's likely to be less economic effect from it than any tax bill that we've seen, which once again tends to leave rates where they are and may leave the economy largely unchanged, which, in the grand scheme, is pretty good. Good weekend.